This segment deals with legal aspects, presented by Roger McGowan, the Leonard Dozal Professor in Agricultural Law and Director of the ISU Center for Agricultural Law and Taxation from Iowa State University, Ames, Iowa.
We want to talk for the next half hour or so on some of the components, the key components to transitioning your small business to the next generation. Any type of family business has perhaps some heirs that are interested in continuing the operation after the generation of the parents, the last of the parents dies, and there are a number of components that are key to a successful transition of that family business. So we're going to hit on a few key components today in the time that we have available to us. Objectives of succession planning, really, when it comes down to it, the whole process has to be driven by your objectives. And so the key to that is to be able to clearly articulate what your objectives, what your goals are to those professionals that are trying to help you transition the business from one generation to the next. They can't help you to the extent that you are not clear in articulating what it is you want to accomplish after you and your spouse are gone. So be clear in articulating your objectives. Obviously give some thought to where it is you want the business to head, what the objectives of your family members are, whether there are some that are interested in continuing the operation after you and your spouse are gone, whether there are those of the family that have no interest in actually running the business but still have an interest in receiving some sort of an inheritance after the last of you and your spouse have died. So be clear about what your objectives are throughout the process. That is the key to successful transition of a family business. Now, if we were to break it down in terms of overall objectives, most people would say, as they want to transition the business, whether it's a farm business, whether it's a non-farm family business operation from one generation to the next, they want to have some success about actually bringing that next generation into the business. Now, certainly there are a set of business owners out there that haven't really given a great deal of consideration to this, and it's going to make transition of the business into that next generation much more difficult. So there are some key components to deriving success in moving the business operation from one generation to the next. You may be providing a vocation for the next generation. This may be what they are planning on doing after they've completed their education or while they're in the process of working on continuing their education. Also, trying to establish a base for a financially successful business operation into the future. And there are a number of key components to that. We may touch on a few of those, and others that are making presentations in this realm may also touch on that. Providing an estate plan that's fair in the farming sector as well as the non-farm sector to both on-farm and off-farm heirs, or those heirs that have an interest in continuing the business operation after the parents' generation is gone, as well as those that don't have an interest. Usually, most parents, when you ask them this question, they definitely want to treat their heirs equitably or equally. Many will say equally, but a key point for them to come to a realization is if they're dealing with children that have an interest in continuing the operation, and they also have children that don't have an interest in actually working in the business after the parents are gone, the parents tend to want to still treat all the kids equally. And what they have to come to the realization is that there's a way to treat them equitably, but yet not involve those family members, those heirs that don't have an actual interest in running the operation. Treat them the same from a financial standpoint as those that do have an interest in running the operation. Plus, it's very important to most people to minimize tax upon transition of the business operation from one generation to the next. If we have time, we'll make a few comments concerning that. Succession planning does certainly thread through other efforts. We don't have time to get into the details of all of estate planning and business planning, but succession planning is part of estate planning. Estate planning is part of succession planning. They're all part of business planning, and the efforts must thread through each other. So successful succession planning does take into effect key components of estate planning as well as business planning, both from a tax and non-tax standpoint. How do you involve children in the farming operation? Or if we broaden that out, how do you involve children in the non-farm small business family operation? The concepts are the same, even though the slide is couched in terms of involving children in the farming operation. Well, if we're talking about a farming operation in particular, and if you want to broaden this concept to non-farm businesses, one needs to take a long-term view of things. Long-term acquisition of business assets in the farm sector, that would primarily be with respect to farmland in the non-farm sector, with some of the most key assets in terms of value. Just kind of think, whatever your business operation is, what are the assets that are would be the most expensive to acquire? Now, in the farming sector, obviously that's going to be land. Land is typically the #1 asset, capital asset in terms of value that is in an agricultural estate. For other family businesses, that might be significant machinery, equipment, facilities, and so you want to take a broad, long-term view with respect to the acquisition of those types of assets, with at the same time perhaps supplementing that business income with what we would call either non-farm income, off-farm income, or non-family business type income, some other type of supplemental income. So one way to transition the business might be that the next generation that does have an interest in coming into the business operation might establish their own complementary business and then gradually acquire those business assets, whether they're farm or non-farm assets, over time, but never really operate in the business on a full-time basis. Another option might be to have off-farm or non-family business employment coupled with some sort of rental arrangement, so that the child over time is establishing their own business and then is gradually acquiring business assets until they're able to participate full-time in the business venture, perhaps upon the retirement or death of the last of the parents, with, again, supplementing that business income with some type of non-business income. In terms of sharing labor and capital in both the farm and the non-farm sense of the term, the parents could loan machinery, other business assets to a child so that the child could rent or own agricultural land or family business assets, but over time there needs to be some sort of sharing of machinery and labor while there is the operation of separate businesses that might be indeed complementary to each other. In the agricultural context, that might involve jointly purchasing machinery, jointly selling outputs of the operation, but yet you would have two distinct operations. Consideration should also be made as to whether a sharing arrangement constitutes a partnership. Just a brief aside with respect to this issue, if you do get into a partnership relationship with a family member, some other type of individual, there might be concerns with respect to what we would call joint and several liability. A partner is jointly and severally liable with every other partner, and so that does raise concerns and points to the need to have a well-drafted partnership agreement that governs these types of issues to minimize that type of liability risk. Also, what happens if a partner dies and who is entitled to a deceased partner's share? Spousal rights can come into play with respect to that and can foil the best laid plans if you don't have a well-drafted partnership agreement that addresses that issue. If a parent and child conducts separate businesses as a means of transitioning from one generation to the next, the child could use, rent, or buy assets from the parents, start their own operation, which tends to work well if the parents are retirement age or very near retirement age, and then the parent could become an employee in the child's business. Now, that won't necessarily work well in all family situations, because there are some families where the parent, particularly the fathers, will not under any circumstance become an employee of the child. That's more of a psychological issue, and a lot of interpersonal skills are at issue on that point and must be played out. But that is one way to transition the business from one generation to the next. Maybe they can work together as joint operators, where the parents and the children jointly start some type of entity, maybe whether that's a partnership, limited liability company, or some corporate form of business. And indeed, that may be the preferred structure to transition the business if the parents are not yet of retirement age. That could involve a single entity, could involve multiple entities. If in the ag sector, it could involve land being rented from the parents individually or from the parents' entity that they own. Same concept would apply in non-farm family businesses, where you've got multiple entities that are created in machinery or other assets, or building space is rented from one entity to the other. That also may provide a greater mechanism for equitable treatment of the family members, the heirs, that do not have an interest in actually controlling the business after the parents have passed on. So to summarize the basic options you have for dealing with a child that comes into the business, the child could use, rent, or purchase assets of the business, whether that's farm assets, whether that's other types of business assets, from the parents, start their own similar type of business operation. Could either rent or buy machinery, rent or buy livestock, and of course the risk-reward issue comes up with respect to all of this, or rent land. Is there neighbor's land that's available if you're talking about a farm sector? Is there an adjacent building that's available if this is a small business in town? And you also have to consider the possibility of creating some sort of taxable gift. And we don't have time to get into that issue, but that's also an issue that needs to be addressed from a tax standpoint as to whether a gift, what we would call a hidden gift, is involved. Business organization strategies. Let's just briefly run through a number of these strategies. Most farmers, and indeed most small family business operations, are sole proprietorships, and they are in a single entity. About 70 to 75% of farmers in this country, where they do have an entity that is created, is a single entity, and most often that is a corporate form. Now that may be taking the form of a limited liability company, which seems to be a very popular form of entity that has arisen over the past 20 years in this country, primarily starting in Wyoming and Colorado in the late 1970s, but has expanded to authorization by statute in every state now. And that's also a very popular form of business for service type enterprises, primarily from a liability standpoint. But most operations are a single entity. They're not a multiple entity structure. If you do have a multiple entity structure, it may look something like this, where you've got your real estate, whether it's the building in town in which the business is conducted, or if it's a farming operation, you've got farmland parked in one form of entity, usually a limited liability company or some form of partnership, perhaps an S corporation, but if it's land, definitely not a regularly taxed C corporation, with that real estate being leased over to the operational side of the business. And that's the business entity that has all the operational assets. It would have machinery, it would have equipment, it would have office materials if it's a business in town, office supplies. If it's a farming operation, that's where your breeding livestock would be, that's where your machinery and equipment would be, where perhaps the child's land would be, and perhaps even some of the other of the parent's land would be placed. A lot of your real estate would be leased to that operational entity. That provides income back to the owners of the real estate entity. And by breaking the business up into two separate entities, it does give us a greater means of equalizing out inheritance between the non-business and the business heirs in the family. The non-business heirs can be given control of the operational entity, the real estate entity, with the business heirs being in control of the operational side of the business, and that is indeed what they want. The non-business heirs want income, and they would receive the lease income under this type of an arrangement. The business heirs want control, and control of the operational entity is what is derived in this type of a setup. Your typical choices for the operational entity include the sole proprietorship, general partnership, LLC, C Corp, S Corp, those five, not necessarily in order of priority, but those are the five typical choices for that operational side of the business. What assets would you place in the business? Well, checkbook for sure, stored grain, growing crops, if it is a farming operation, also livestock, machinery of the business would be placed into the operational entity, but very limited real estate inside that operational entity. That would be in your real estate entity is where you would park that. In terms of the landholding entity, it's usually a sole proprietorship or an LLC. Do not put real estate in a corporation. This used to be the technique in the 1970s up through the mid-1980s, but with the Tax Reform Act of 1986 and the double tax effect of extracting land out of a C corporation, that can become very, very costly. We no longer suggest that that be done. There is a way to get out of that, although it takes an unwinding process of about 10 years to successfully get around that double tax effect that came into play in the 1986 Tax Act and the repeal of what we call the General Utilities Doctrine. How do you achieve equitable treatment for the heirs not in the business? Just to summarize again, it is typically not wise to involve off-farm heirs or non-business heirs in the day-to-day operation of the business. The business does not distribute typically income. All that income that the business generates just simply gets plowed back into the business because they need it for operational purposes. Plus, the operational business may have day-to-day decisions that don't match the objective of the off-farm heirs or the non-business heirs. See, they want cash coming out of that business. Most small family-run operations are simply plowing the earnings back into the business, and that's not going to jive with the objectives of the non-business heirs. Ownership is usually small, compared to the on-farm heirs. And so they can be frozen out of a lot of decisions as minority shareholders in the business. They have little rights over anything. They can't control decision-making, can't control liquidation, can't force a distribution of income out of the operation. And so at some point in time, they'll become very frustrated in that type of a setup. Plus, there's little incentive for the on-farm heirs to buy out the interest of the off-farm heirs, or the operational heirs to buy out the interests of the non-operational heirs. And the value of that minority interest can suffer from a severe valuation discount because of that fact. You could balance out inheritance, treatment of the heirs through inheritance or pre-death gifting, or naming them as beneficiaries on life insurance policies or beneficiaries of retirement plans, or perhaps by means of buy-sell agreements, which we'll talk about further and more fully in just a second, possibly in conjunction with gifting of assets also. Also, the non-business heir, whether it's the off-farm heir or the non-family business heir, again, as we said just a moment ago, may not be distributed an equal share in the value of assets. And if they were to receive the business real estate, it should be subject to a long-term rental contract in favor of the on-farm heirs or the business heirs' business. Subject to purchase options, probably a buy-sell agreement, and perhaps through the use of some type of entity where all parties are co-owners might lead to more equitable treatment of these non-family business heirs. But seldom is it recommended that real estate be inherited by children as tenants in common. Unfortunately, that tends to be fairly common. The problem with that is that it can lead to what we call a partition and sale action. Now, there are two options with respect to that, because all of the owners are deemed to own the real estate in co-ownership and undivided shares. At some point in time, the non-business heirs are going to want to get their income out of that real estate, and they can force a partition and sale action. That's a judicial action where the court will either distribute property in kind, or will say this is not appropriate for an in-kind distribution. We will have to partition the property and sell it in a judicial action, or by means of judicial action. And that has the possibility of fracturing the business and leading to long-term non-viability of that business. And that's not a good idea. So we need to engage in some additional planning to make sure that that doesn't happen, and that is one instance where the creation of an entity or multiple entities can get around the right of partition and sale in disaffected heirs. In terms of transferring assets, there are various ways to transfer assets from one generation to the next, perhaps by gifting assets pre-death, consistent with presently the $12,000 present interest annual exclusion for gifts to an individual where it is not subject to federal gift tax, and a federal gift tax return form 709 need not even be filed. Renting of assets also pre-death, perhaps selling assets to heirs, whether that's real estate, whether that's machinery that's involved in the business, or even the parent's residence might be sold on some sort of long-term installment contract. Also, there might be various types of inheritance strategies that could be utilized in this situation, what we would call testamentary type transfers. Social Security planning comes into play also in terms of the parent's exit strategy. Do they want to retire at or before full retirement age? There are lots of things we could say with respect to this. What you really need to do is sit down and take a look at what the financial hit would be if there's going to be a retirement before full retirement age, and how that impacts payment of Social Security benefits, and how much is the reduction in Social Security benefits for that retiree if they retire early as opposed to retiring at full retirement age. Also, there may be some complication with prepaying expenses in terms of Social Security planning. In terms of using trusts to provide for the spouse and the next generation, let's just make a few brief comments concerning that. What we have here is what looks like a rather complex diagram, but basically what we're trying to illustrate with this diagram is optimizing the use of the existing exemption equivalent of the unified credit at the time the first parent dies. Presently, each individual can die with an estate of up to $2 million and not have any shrinkage in value for federal estate tax purposes. Federal estate tax for deaths through 2008 does not apply until the taxable estate is over $2 million per decedent. That level is going to $3.5 million for deaths in 2009, Under current law, there is no federal estate tax in 2010, and then in 2011 the federal estate tax comes back with only a $1 million exemption and the top marginal rate at 55%. So what we want to make sure we do is try to ensure that the estate planning documents dovetail with the succession plan. And we want to maximize in those estates where there's potential for federal estate tax, maximize the use of the credit exemption in the estate of the first spouse to die. And many times, since we can't predict the order of death with perfect accuracy over both spouses, we end up with what we call mirrored wills, where Dad's will have the same tax provisions in it as Mom's will does, so that it's irrespective and it doesn't matter which spouse dies first. The plan works the same forward as it does backwards. So what we're trying to do is shelter the maximum amount that we can from federal estate tax by causing that to be taxed in the first spouse's estate, covered by the exemption, with that property passing in life estate form to the surviving spouse, with the balance of any property passing outright to the surviving spouse, covered by the unlimited marital deduction, with the remainder interest on both of these interests going down to the children. So we're able to move property under current law up to $4 million through both spouses' estate down to the kids entirely tax-free. That will cover the vast majority of small business operations that are out there. There won't be very many that have values in excess, net worth in excess of $4 million, such that we would have to worry about shrinkage in value to pay federal estate tax. Some states, Kansas is among those that are in the process or have already repealed state-level inheritance tax, but in other states, state-level inheritance tax still applies, and that is a concern that has to be dealt with. So, and that's beyond the scope of what we're talking about during this session. But the life estate property, as you can see in the diagram, the earnings from both of these trusts that we're setting up under the terms of the parents' wills, these testamentary trusts, provide income to the surviving spouse for the surviving spouse's life, as well as principal for that spouse's living needs, with the property passing ultimately to the kids upon the death of the surviving spouse. Then upon the death of for a single person, you can see first of all that illustrated here, title to assets would simply be retitled in the names of the children after the surviving spouse passes away. In terms of generation skipping, there is, just to make note here, some have thought that they'd be fairly clever and simply skip the possibility of taxation at a surviving spouse's level and move the property immediately to a child. That brings in a new tax known as the generation skipping transfer tax. If you skip a generation, Congress has created another tax to pick up the estate tax that would have been paid had you not skipped that generation. And that does come into play when we're talking multi-million-dollar estates, typically above the exemption equivalent of the current unified credit. So very few people will get into generation skipping type situations, but in the event you are dealing with larger values, then we do need to talk about generation skipping type plans. Custom distribution plans within trusts. Well, machinery of the business could be distributed to the on-farm or the on-business heir, the business heir. Could be a buyout, rental options with respect to the assets, rights of first refusal, purchase options. Non-business assets could move directly to the non-business heirs with a sharing of appreciation amongst all the heirs in the business assets, as well as sharing estate settlement costs being in proportion to the value of the assets that that particular child receives. Buy-sell agreements. A few quick comments with respect to buy-sell agreements. Potential transfer and interest to someone in the business who should not be in the business, or potential transfer of business assets, stated more carefully, to someone who shouldn't be in the business. That's what we want to avoid. And the way we avoid that is by means of a buy-sell agreement. This gives, typically, the way it's structured is to give the business heirs, or what we would call the on-farm heirs in the farm sector, farm setting, the right to buy out siblings, so that the non-farm siblings or non-family business siblings, those that don't have an interest in continuing the business after the parents have passed away, we give them the right to receive cash because the business heir has the right to buy their interest out. And there are certain events that we set up in these agreements to trigger that right. That becomes a very critical document. In fact, I think just about every successful multi-generation type business should have a well-drafted buy-sell agreement. And it may just be simply critical for just about every business to have if there's a concern for successful business continuity from one generation to the next. Typical provisions you'll find in these agreements would be a clear specification of what events trigger the right to exercise the buy-sell. What are the rights to purchase? How do you value the business assets at the time the triggering events have occurred? And the funding of the buyout. It doesn't do much good at all to give a child the right to buy out their siblings if they have no funds with which to exercise that right. So in that instance, we look for means of funding that buyout. One popular means is by way of insurance on a parent's life or on both parents' life, with the payout, with the proceeds to go to the heir that is to continue the business, and they use those proceeds to fund the buyout of their non-business siblings. And that's the typical setup. In fact, that's probably the preferred approach. Let's talk about a point here that many people don't want to talk about, but can throw quite a wrench in a successful transition of the business from one generation to the next, and that's the issue of divorce. What if you've involved a child or numerous children in the business with you as the parent, and it's a married child, and after a few years of successfully operating alongside that child, there's a divorce between that child and their spouse, and maybe the spouse of your child is also involved in the business. That can really create a problem. And what if divorce occurred after gifting of assets to the spouse or to the child and their spouse has already occurred? Or if divorce occurs after an inheritance has been received? Are there ways to deal with this issue? Well, first of all, I guess the key point to consider right up front is to consider the possibility of this happening, and then think about what can be done to minimize its impact on successful transition of the business or the viability of the business itself from generation to generation. You might be able to handle this through trusts, buy-sell agreements where divorce is a triggering mechanism under the buy-sell agreement. How might it affect business entity selection? And I think there probably are some benefits here to having more than one entity to ward off the potential problems that divorce can occur. Who should be co-owners of the business? Consider involving or not involving the spouse of a child in the business. If you do involve the spouse of a child in the business, consider the possibility of divorce, and what have you done to plan for that contingency? What might happen, as I indicated earlier, if, for example, a son-in-law is already involved in the business? How would the business be impacted? What can we do to address that issue? Really need to talk to your professional estate planning, business planning, succession planning team to deal with this potential contingency. But buy-sell agreements are a real good way to ward off potential problems with respect to divorce of a child that's already involved in the business. Again, just by way of recap, your basic entity choices, I think there are a number of these. We've mentioned just about all of those so far, except the limited liability partnership, which is simply a highbrow form of limited partnership, as well as the co-op. Very few non-farm businesses will choose the cooperative type of business arrangement, but it may have some merit with respect to particular types of businesses. Income taxation, just a few points here on income taxation and perhaps accounting. This does have an influence on the way we want to structure the business, one entity, type of entity, whether you want to have multiple entities or not. Self-employment tax comes into play, fringe benefits, really depending on how big the operation is, how many employees you have, whether you do have a desire to provide tax-free fringe benefits that are deductible at the corporate level and not included in the employee's income becomes a bigger issue as the operation has more and more employees. Also a consideration is once we create a particular business form, how easy is it to get out of that form? And so there's a difference between C corporations and S corporations and various types of entities on all of these points. And really what you need to do is determine what your issues are and then consider how each of these types of entities play out with respect to those respective issues. And then discounting a business interest. That's an issue that is very important for those business enterprises that are of substantial value, well over the exemption equivalent for federal estate tax purposes, or if you're looking at gifting interests in the business pre-death to the next generation. You might want to consider multiple entities. The type of entity matters here with respect to discounting of business interest, but definitely creation of an entity as opposed to just simply the sole proprietorship form can generate significant tax savings by virtue of discounting those interests from their fair market value. Over the last 2 to 2.5 decades, one of the most well-known concepts that has been blessed by the U.S. tax court has been the concept of discounted interest in family-run, non-publicly traded businesses. And we just saw a case just a couple of weeks ago coming out of Minnesota involving a farming operation where substantial discounts for a family limited partnership were generated. Now, the service has had tremendous success attacking discounts, but that case still stands for the proposition that if you structure the business entity correctly, operate it properly, you can still receive significant valuation discounts and save a tremendous amount of tax dollars. Let's take a very quick example with respect to some tax analysis. Let's assume that I'm not incorporated, I'm not operating in any type of business form, just a sole proprietorship. My business net income is $60,000, and my spouse has non-business income, and using a farm example here, but non-business income, off-farm income of $30,000, and then we have other income of $10,000 between us. So our total income is $100,000, living expenses of $60,000, which leaves us discretionary income of $40,000 to either continue to expand the business or pay down debt, which is the two most popular means of using that discretionary income, particularly when you're talking about farming operations that are family-sized farming operations. Now, if I'm a sole proprietorship, tax-wise, this is what happens. My AGI is $100,000. Let's say I have a couple of dependents, so I'm going to pull out two dependency deductions of $6,600 total. Standard deduction of $10,300, and these would be the numbers for 2007. Taxable income then is $83,100. The tax on that, when you look it up in the table and apply the rates to it, would be $13,884. Then we apply the Social Security tax to that on the $60,000 portion of the income at 13.1%. That's to reflect the deduction we get for part of the SE tax. So we get a deduction off the 15.3, drops us down to 13.1. So we have SE tax of $7,860 for a total tax bill of $21,744 on an AGI of $100,000. That leaves us just a little bit less than $80,000 to play with. Now, if I'm a corporation, I've got $40,000 of discretionary income taxed at a 15% rate. That's the corporate rate on that income. So that's $6,000 of tax there. Adjusted gross income is $60,000. That's the other income not run through the corporation. Dependent deduction $6,600. Standard deduction on the individual return again $10,300. Taxable income $43,100 for a tax of $5,714. Now the Social Security tax, in this instance, we've got $20,000 subject to SE tax at 13.1%. For $2,620, our total tax is $14,000. You compare that to the previous scenario, total tax of $21,744 in a sole proprietorship. Just simply by incorporating the business, we've dropped the total tax bill down to $14,334 for a savings of right at $7,000. So we reduced our tax liability by about a third, leaving us not just a little bit under $80,000 to play with, but about $85,000, almost $86,000 of income. So that's, you expend a little money, of course, to operate the corporation, to get it created, get it formed, attorney's fees, and all types of other fees, but as that corporation operates from year to year, there will be some tax savings. Now, obviously, it depends how much income the corporation is generating, because that will peg the bracket that that income is taxed at. But up to $50,000, you're taxed at 15%, and that is a higher cut than the 15% adjustment, or the upper end of the 15% bracket for individuals. So there is some gaming of the marginal income tax brackets that can be played by incorporating the family business as opposed to simply being a sole proprietorship. And these benefits get bigger as the entity gets bigger and you want to start providing tax-free deductible fringe benefits. Deductible at the corporate level, tax-free to the employees. Also, when you're considering your entity choice, always consider how easy it is to transfer interest in that business and how it will impact continuity. If it is a farming operation, you've got to take into consideration the farm programs, FSA payment limitation rules, Now, as I'm speaking right now, as this is being taped, we're still not sure whether we're going to have a farm bill or not this year. The House and Senate has approved a farm bill, likely pass the Congress just this week as we speak in mid-May. The President may veto that bill. We may end up with a 1-year, 2-year extension on this bill. That remains to be seen at this point in time. But the point is, whatever the rules are, if you're dealing with a family farming operation, your practitioners that you work with should be up on payment limitation rules. That can be very important in terms of generating additional income for that family business. Management structure is important in both farming and non-farm family business operations. Do you have a single manager? Do you have multiple managers? What's the liability of the owners in that business for torts and other types of legal liabilities that arise out of the operation of the business? If you're a sole proprietor or in a general partnership, or you're a general partner in a limited partnership, you have what we call unlimited liability. And so that may not be the way to go. If you want some type of limitation on liability, and many professionals and those in service industry do, that means you want some type of limited liability company. S Corp, C Corp, being a limited partner in a limited partnership, that will provide some liability protection. And that can be a very important point in this day and age that we live in, and a society that seems to be very bent on filing of lawsuits. Well, we do thank you for your time. All of these concepts can be expanded, obviously. If you do need additional information, feel free to contact us at the center. We'd be glad to help you. Also contact your local extension office here in Kansas also. You have the contact information again on the screen for you. My desk number, my staff attorney's desk number, our email addresses, and our center's web address. Again, we do thank you for your time.